What's up, traders? Most new traders look for indicators, the indicators that will give them the most accurate signal, the holy grail. But unfortunately, there is no indicator can give you that kind of signal because indicator based on past market data. It doesn't count what's currently doing the buyers and sellers in the market. So to know that what's happening in the market, the only way is to learn the price action trading system. And remember, price action trading system is used by big boys, hedge funds, most professional traders and successful traders. So in this video, I have given everything you need to know to become a price action trader. Sound interesting? Then smash the like button. And also, if you're new to the channel, don't forget to subscribe. I pause the video, click the red button, subscribe. There will be a lot of content that will change the way you trade. For those who don't know me, my name is Nizam. I'm a professional forex trader and also helping others to become profitable. With that said, let's begin. To become a price action trader, I have given 3 important key points that you need to understand. First one, market structure. So what is a market structure? Trending or uptrending or downtrending. So the first of all, when you open a chart, you need to understand which way this market is moving. Is it trending? If it is trending, then it is uptrend or downtrend. This first of all you need to identify. Or if it is a ranging market or sideways market. So the first key point that you need to understand as a price action trader is market structure. Now I will show you in real chart how it looks like to understand the market structure. So first of all, when you open the chart, you need to identify the market structure. The market you are looking, you see the some candles chart, but what is the market structure? Either it is trending or sideways. The first thing you need to identify. So to do that, what you will do, you'll find out either this market doing like this, that means it is creating a series of higher high and higher low, or it is creating a series of lower high and lower low. So this is in downtrend. So if you see that the market is creating series of higher high house, say for example this is a high followed by a retracement, another high followed by a retracement, another high followed by a retracement. So every time it is going up, creating series of higher high and higher low. So these types of market, what we tell an uptrend. Okay. Now if you see the market is creating series of lower high and lower low, that means the market is in a downtrend. So every time it is moving, it is creating series of lower high and lower low. So in that case, this is in a downtrend. What if neither of this happening? If the market is moving like this, okay, so this what we call a ranging market or sideways market. That is, it is neither creating a higher high nor a lower high, but equal high. May not be exactly equal, but comparatively equal high. So these types of market we tell as ranging market. This is the first thing you need to identify. Now let me show you a couple of examples. So now let's look at this example here. So what happened? There is an impulse followed by a correction, another impulse followed by another correction. So every time what happening? The market is creating series of higher high and higher low. So this is in an uptrending market. So you know that the market structure for this zone is in an uptrend, right? Now let's go down to a ranging market. Okay, so let's see this market here for this zone. Say you are trading in this area. Okay, so what kind of market is this? Very simple, isn't it? It's a ranging market or a sideways market, because this market in this zone is basically not creating any kind of higher high or higher low, but it is ranging in between a support and resistance. So if you draw a support here, say for example in this zone, you may not get exactly textbook example always like that. There will be always, in practical, there will be always some deviation. So if you, at best, if you draw this, then what you see that the market is basically, this market is ranging in this zone. So if you draw this one, what do you see? That the market is basically ranging from the in between this range. Okay, so this kind of market we can say as ranging market. So these are the first thing you need to identify. Okay, so once you identified the market structure, you have identified either it is an uptrend, downtrend, or a sideways. The next thing you need to find out supply or demand zone in that market. Why? Because you need to make a decision, either you will be buying or selling. Because when you see a market structure trending to the upside, you will be buying. When you see a market structure trending to the downside, what you will be doing? You will be selling. If you see a market in a sideways, then what you will be doing? You will be in the sideways. No, sometimes you will be buying or selling as well. When you see a price in the support in a ranging market, you might be able to buy. When you see a price in the resistance in a ranging market, you might be selling. So when you identified the market structure, the next thing you need to find out supply and demand zone. So what does it mean? It means that you need to exactly identify support, resistance, or a trend line in the market to find the potential buying or selling opportunity. And also you can identify the key level, middle level, and gap levels. So these are the levels and area of value you need to find out after identifying the market structure. So now let's find out what are these. What are support, resistance, or a trend line, and what is key level, middle level, or gap level. Okay, so let's say this market we consider. Okay, now we wanna buy in this market because this is an uptrending market. As you know that it is creating a series of higher high and higher lows. Okay, so we'll be only considering buying, but you cannot buy at any point. If you buy at any point, then you will be end up losing a lot of trade. You need to find a proper place where you can buy from. So for an uptrending market, the best place could be on the trend line, right? So let's draw a trend line. So this could be a potential trend line or trending zone. So if you draw a trending zone, these are the zone that you can consider potential buying opportunity. Now what you will be doing, basically you will be waiting for the price to create an impulse correction, correcting to the trend line, and again followed by an impulse, again correcting to the trend line, and again followed by an impulse correcting to the trend line, followed by an impulse correcting to the trend line. So when it is coming back to the trend line, that time, that is the point that you have to identify, which we can say the area of value, where you can buy in an uptrend or sell in a downtrend. So let's see another example for a downtrending market. Okay, so for example this market here, okay, this zone here, this zone is in a downtrend, right? Say for example you wanna, after you saw this, you wanna sell in this market after this reversal. So what you will do, you will first basically draw this line. So this is what we can say a trend line. Now when there is an impulse followed by a correction to the trend line, again impulse followed by a correction to the trend line, impulse followed by a correction to the trend line, and then impulse followed by a correction to the trend line. So these are the zone on a downtrending market that we can say the area of value where you can consider potential selling opportunity, and that is what you need to look for in the market. Now let's see a support or resistance in a ranging market. Okay, so let's say this example here. Okay, so this zone, say for example you are trading in this zone. So this zone basically is a ranging market. How do you know? If you see that it is not basically creating any higher high or lower high, but it is in a range. So it may not be exactly always, as I told you, because in real market you will never get an exact, but you need to find the proper value, area of value. So from here, what happened, the price after this is consolidation, the price created this high and came back to this level, couldn't break it, went to the upside, again rejected to the downside. Every time is coming to this zone and rejecting to the upside. So what we can say, that this from here the price is basically moving up every time and creating a range or sideways market. So if you draw a support and resistance in this market, what do we say? That this is a support zone where the price is coming and rejecting, and this is a resistance zone where the price is coming and rejecting every time. So these two zones, we can say the area of value in a ranging market, where we can, from here we can consider potential buying opportunity, and from here we can consider potential selling opportunity. Okay, so these are the way that you can identify area of value in a ranging market. Now let's learn what is key level, middle level, and gap level. Okay, so now learn the key level. So what is a key level? A key level is a level in the chart where price came in the past and bounced. So normally you need to draw a key level on a higher time frame, such as on the daily, weekly, or monthly time frame. So as an example, if we see this instrument, British pound US dollar, what do we see? That see the top of this candle here, 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 every time where the price came here, bounced from this zone, right? So we can say this is a key level. So to draw the key level, what you will do, just take a line and try to connect all the top of the candle where the price have been bounced from. So what you see, that the price bounced from here, okay, here from the same zone, here on the daily here, so here also, and here it couldn't reach, but this is what happened. So we can say that this is a key level, and this key level can act as an important area of value, and you can have an enormous potential to buy or sell from this level or from this zone. Now let's learn what is a mirror level. So mirror level is basically a key level, but the difference is that in key level is what we consider that the price came here, bounced to the downside. So every time the price is bouncing to the downside, right? So we can say it is a key level. But mirror level is like a level when, say like this, say for example, the price came here, bounced from this zone, again came here, bounced from this zone, and then broke to the upside. Okay, after that what happened? The price came back here, test this level, and bounced from here. So this level, it was up to here, was a key level. Now we can say it is a mirror level. Now mirror level is super important because mirror level is the most difficult level to break, because in both sides price have been bounced from here. There it acted as a resistance here, now acted as a support. So the same level acted both as a resistance and acted as a support. So we can say this is a mirror level, which is very, very important. Now let's learn gap level. So gap level is basically when there is a gap opening. There is a perfect example here in the British pound US dollar that we are talking about so far. So there is a gap, see, there is an opening, and then there has been a gap opening here. So after this gap, what happened? The price went up, consolidated, and then broke below. So this level we can say as gap level. Gap level sometimes can provide a very, very good opportunity to buy or sell. So gap level, normally if you have a big gap, then this gap can act as a support or resistance. In this case, here what you see, the price broke this level because it was resistance here, resistance here, resistance here. Now it has broken above, so it acted as a support in this zone, and it acted as a strong level of gap level. Okay, so this is the second step that you need to take when you are looking at the chart. Now let's jump on to the third step, that what you need to look for in the chart. Okay, so the third step that you need to take is to look for candlestick pattern. Now, the biggest mistake most trader does is they always price trade based on candlestick pattern. Say for example, they see a shooting star or a pin bar at any point and they go for buy or sell. But if you do not learn the previous step that I told you, then candlestick pattern will not bring any meaning to you. Okay, candlestick pattern only valuable when they are based on market structure and in an area of value. That is what you need to understand clearly. So what is candlestick pattern? Candlestick pattern is basically a price action pattern that you see in an area of value. Now I will explain clearly what is candlestick pattern in area of value, but I have a complete course on all types of candlestick pattern. I will link it here above. You can watch that. That is really helpful, will be helpful if you want to learn all about candlestick pattern. But in this one I will just show you that in an area of value, that what kind of candlestick pattern you will look for. Now look at this market here. So what you see here, this is in a downtrending market. How do you know? Because if you see that the price starting from here, coming down, going back to the trend line, and again coming down, going back to the trend line, coming down, going back to the trend line, everything, and broke here. So until this zone, what do you see? The price was creating a series of lower high and lower low, and we can consider it as a downtrending market. So when you see a downtrending market, what you will do first step is you will find out the area of value. So when the price is coming down and falling back to the trend line here, and then coming down, falling back to the trend line, so these are the zone that you will be looking for potential selling opportunity. Remember, in a downtrending market, never consider buying, only selling. So in that case, what do you see? That after these two touch, maybe we can consider here thinking about, okay, there is this is a trend line, downtrending market, I will be selling, and then you will be waiting for the price to come here. Now when the price come here, what you see? You found market structure, downtrend, you found trend line, area of value. Now what you see? That look for a candlestick pattern, and after that what you see? This red candle, which is kind of bullish engulfer, pardon me, bearish engulfer. Why? See, after this trend line, what you see? This red candle basically crossed all these candle, the previous candles, completely engulfed, and we can consider after this candle selling from this trend line with a good risk to reward ratio. And after that, what happened? The price came here, you have a winning trade, and then again price went back to this level. What happened? The price created a long pin bar. So after this pin bar, what you can think of? Well, this is a perfect candlestick pattern on a level of trend line or on a level of dynamic support. I can go for short from this zone, and when you go for short, you have another winning trade. Okay, so in this example, we will see both ranging market and as well as key level example. So first of all, look at this market here. The price came here and then created a range, series of equal high and sideways market. So when you see a market like that, what you will do? Just draw a level of resistance all around here, and also draw a level of support connecting all the lows and highs. And when you found this, what you will be doing? Basically, you will be waiting. So this is a market structure that you have drawn like this. Okay, market structure. And then what you will do after you found the market structure? The next thing you will do is finding the area of value. So what is the area of value? The area of value is here, okay, and here, because these are the zone the price came and rejected to the upside, and also in the top, these are the zone where the price came and rejected to the downside. From here also rejected to the downside, from here also rejected to the downside. So when you see identify the area of value, that means the supply and demand zone. The next thing you will do is look for the third step is candlestick pattern. Now look at here, when the price came here, what you see, a big pin bar, right, from this zone. So now the first thing you might say, well, here I didn't know that this is gonna be range because there is nothing in the left. Okay, in that case you have to wait. When you see here the same zone, look at here, when you saw the price came here in the same zone and then aggressively rejected to the downside with a strong bearish engulfer. So if you see closely, what you see that this red candle is a bearish engulfer, perfect bearish engulfer. When you see a bearish engulfer, you can easily go for short, because at that time it became a range market. You see that it couldn't break the previous level high, so in that case you can go for short from here, or from a certain point, keep it in stop loss, and you can have a very good profitable trade. After this one, what happened? The price came back to the same zone again same thing happened, the price rejected. When the price rejected, so you found the area of value, you found market structure. Now what you saw, a pin bar on the level of resistance. When you see this pin bar, well, you can go for short because you got a pin bar, you have a market structure, you have area of value, and you found a candlestick pattern. So this is where you can go for sell. So this is the example of ranging market. Okay, so now let's do a quick summary on what we have learned so far. So the first thing you have to do as a price action trader is to identify the market structure. So what is a market structure? Is to find out either market is in uptrend, downtrend, or in a sideways or ranging market. The second step that you have to do is to find an area of value. That means draw a trend line, key level, or a support or resistance where the price have a high supply or demand. The third step or final step that you have to do is to find a candlestick pattern or an entry trigger for buying or selling opportunity. So these are the easy 3 steps that you can do to become a price action trader, and this strategy is really helpful. You don't need any other things if you understand it. If you have any question, just comment below. I will get back to you straight away. I sincerely believe that this video was helpful to you, and thank you for watching. I'll see you in my next video.